Happy Monday morning. Doing a quick YouTube on PLYM after I've had the whole weekend to digest it. Just want to talk a little bit more why I think it's attractive here for the Go Shop when I normally think Go Shops are not worth speculating on. So there's a few different ways you can look at this when it comes to why I think there can be a superior bid coming in the next 30 days. I don't think that's the base case, and most people think it's very unlikely, by the way. Why do they think it's very unlikely? Well, the first reason is this is a public process. Public process versus private process is very simple. It just means that the world has been alerted to a bid or a formal process. And that's the case here because in August, they 13 deed 6th Street and the company press released that there was a $24.10 bid. Presumably, that means that the whole world could have called Plymouth and said, I'm interested in buying you. And sure enough, 10 weeks later, we have a sale at $22 a share to a third party, right? Not to 6th Street. So we know other people were allowed to participate, and we know that 6th Street did not end up being the acquirer. Why do I find it attractive given those circumstances? It's simply because it happened very quickly. It took 10 weeks or so from the original 13D to this sale, and it wasn't 6th Street that bought them, but a third party. And this third party is far from the lowest cost of capital. It's a new hedge fund that just launched that is aiming for a 1.5 billion first round in total committed capital. And this is probably a $500 to $750 million equity check. So you have to think that there are larger REIT players out there that can pay more for this. Financial players that might be able to have a lower cost of capital. I realize the cost of capital is pretty similar across private equity funds, and it's a simple Excel spreadsheet to try to come up with what your IRR is. But the larger players should have some element of synergy here with either portfolio companies or just the sheer nature of fundraising to where they can, have slightly lower IRRs maybe in a hurdle rate. So it surprises me very much that this was the ultimate buyer. And finally, that the price was $22. Okay, the way I approach it from that perspective is in the last 2 months, the market has only gotten better. Okay, cap rates have gone down. The 10-year has gone down. The 10-year's gone up. Yields have gone down. And competitors of PLYM have gone up about 10% since mid-August. So you have to believe that the value of Plymouth, whatever that would have been in mid-August, is more today than it was when this initial bid was made. Usually when we have take-unders, when I say take-under, I mean below what the initial 13D bid was, it's because market conditions have deteriorated. And that has not been the case here. So we're left with not knowing a lot of things, right? We don't know why why 6th Street bid in the first place and then decided to walk. If they did find something in due diligence, which seems like that was likely, then we don't know why there was another bidder that was interested in buying them at $22, okay? One of the big questions I have is why the management team even sold at $22 and the board when they were never aligned in the first place. The board owns virtually no stock and the management team has a few 100,000 shares, and they'll make more money in a year off total comp than they will off of the premium from $15 to $22 on their few 100,000 shares. They'll make much more money keeping their salary and getting REIT compensation. So the way I look at it is this. It's $21.85 now. It was $21.70 in after hours on Friday, which I found very attractive, and I bought more shares there. Here, you're only getting about 75 basis point spread, and this is going to close early 2026. We'll call it, February 15th, 2026. I think it'll close faster than that, but let's use February 15th. We are at the end of October, so it's all of November, all of December, all of January, and half of February. It's about 3.5 months, and you're only going to get 75 basis points, okay? How much do you think you should have to get to hold this, for that time period? If there was no chance of a superior bid, you probably need to get something like a 7% IRR, okay? A 7% IRR for 3.5 months is probably something like, I don't know, a little bit more than 1.5% gross spread. So call it 1.6, 1.7%. We're getting 75 basis points now. So we're paying about 1% right now for the Go Shop, or about 22 cents a share. Okay. And I think that 22 cents is very attractive because I do think that if I'm right, that there is a good chance that this was kind of put together in a fast manner and more like a stalking horse bid than an actual fully shop process, then that 22 cents could end up being worth 2 or 3 or 4 dollars when this is all said and done. So if I use $24 as my base case, if there is a bidding war and an alternative proposal, you're paying 22 cents for $2. So you're paying about 11% chance of a superior bid. And I think it's much higher than 11%. I don't know what the right number is. It's not higher than 30%, but I think it's higher than 11%. And again, these ghost shops almost always fail. So I will not be surprised in 30 days if there is not a superior bid. They're set up to fail usually. The way the break fee works here is if somebody that previously bid, aka Sixth Street or anybody else in the last 10 weeks, submits a superior proposal, it's only a $15 million breakup fee, which is something like 30 cents a share and less than 1% of the EV. Totally doable, not a game changer by any means. If a new bidder comes in, they have to pay 45 million, which is, or 40 or 45 million, which is close to $1 a share, which is real money, right? If I think this is worth 24 or 25 or $26 and it's trading it gets sold for 22, that dollar is a huge chunk of that $3, $4, $5 incremental value, and it might be enough to dissuade people from getting involved here. So there's that. And the whole thing's puzzling. So the final thing I'm going to say is, why did Sixth Street do this? They don't own any stock. They have some preferred stock that can be converted to cash when this deal closes, and they have warrants. And the warrants, they go down in strike price with every dividend that's paid. So they were originally struck at 25, 25, 25, 25, 26, 25, 27, 25 a year ago. And they're 5-year warrants that have up to a 2-year extension for some reasons. It doesn't say for what reasons. So I'm just going to use 5 years. Over those 5 years, they'll pay about $5 in dividends. So those warrants go down to 2025, 2125, and 2225 at expiration. And it's my belief that the business is worth mid to upper 20s in a private value. Though right now the answer is it's worth 22. If we don't get more than 22, then that is what the private market value is of it. But even if you use 22 today, that's more than 2025, 2125, and 22, not more than 2225. And certainly it could be worth more than that in 4 years from now. So they gave up millions of dollars in value by putting this in play in August and now not being the buyer in October. And it really is confusing why they didn't end up ultimately making a bid. Assuming they didn't see something in due diligence, the best I got is they were playing hardball with price with the management team. And this is very unlikely, by the way, but it would be that they're playing hardball in price. They found a friendly bidder at 22, and they put this pen to paper to kind of push Sixth Street to bid or shut the fuck up in the next 30 days. And the cost will be just $15 million or 30 cents a share to shareholders, which is de minimis. That's not the likely reason why they didn't bid. The likely reason is that they saw something in due diligence, or they just simply changed their mind. Changing their minds, to me, seems unlikely. These are pretty straightforward assets. They list all the leases in the 10K. They know all the assets really well from their process a year ago with Plymouth. Reminder, they have a joint venture together. And we won't know until the proxy comes out why they didn't end up winning. But I really like the setup. Honestly, I would still own it at 22 right now with no yields. That's Andrew Walker. I'm going to turn him down and call him back later. So shout out to Andrew. So that's all. I think the right price for that ghost shop today is probably like 40 cents, which is why I think it should probably be about $22 right now. And we'll see if I'm wrong. Worst case is it'll go down to a 2165, 2170 area in 30 days if the ghost shop fails, because I think that the deal is as ironclad as you're going to get in this business. I don't see any chance of it breaking no matter what happens from a macro perspective, et cetera. The debt financing is ironclad, and the business is a boring industrial REIT. I just don't see what's going to happen that's going to be able to get them to break the merger agreement, no matter what interest rates do, et cetera. All right, that's all. Let's see what happens in 30 days, and hopefully I'm with you later this week, and we get some good news and something else in my portfolio like forward, though. Clearly, I don't expect anything there anytime soon since that article was just last Monday. We probably won't hear anything for at least a few weeks, or maybe the eve of earnings if they finally decide to make price with the private equity firms. All right, everyone, take care. Have a great week.